Where is Bitcoin going? How low is it going to go? Let's dive into the charts. All right, here's your Bitcoin chart. Take a look. Down 5% today, almost or over $4,000 drop on Bitcoin. And this was really something I choreographed literally weeks ago, right? We talked about, we had this beautiful bear flag. And if we connect these lows, look at how perfect this is, right? So on Bitcoin, you have this low, then you connect it to that low, and then look at how price broke, and then it tried to recapture. It tried to push back above, and it couldn't. And then you got another red close and a confirming candle. And then it tried one more time to fight back, and it still couldn't do it. And this is one of those things in technical analysis that we all have to understand. It's called path of least resistance. And it's something we all do in our own life, right? When something's hard, we look for an alternative. We oftentimes choose a different path. Charts do the same thing. Why? Because it's based on human psychology. Always remember that, guys. So the point being, path of least resistance, it couldn't get through this line. What happens? Price takes a nosedive. Bitcoin dropping from over 90,500 to now 80,000. In fact, we did pierce 80,000 here. Now, this is the kicker, guys. So number one, this is, you might hear me say, well, this was a bear flag, and this is how I knew that this was the likely outcome, right? And the answer is very simple, right? So this is your bear flag formation. You had this bigger drop, and this was all inside bar consolidation. That's classic bear flag formation if you know technical analysis, even the basics of technical analysis. The other thing to just point out is I called the high in October of 2021, and I just want to remind you guys about this because going back, everyone's like, oh yeah, Bitcoin topped, but the way I was able to do this, because remember, in October, everyone was telling me, heck, even Tom Lee was calling for 250,000 Bitcoin by year end. Obviously, that didn't happen. But look at the beauty of this trend line. I mean, how amazing is this? You have your 2017 high connected to your highest point there. Notice, note this second high doesn't touch the line. This is the one that touches the line. And then look, hits, rejected, hits, rejected, hits, rejected. What did we just talk about? Path of least resistance. You can see it occurring right here, right? Hits, rejected. Comes back up, hits, rejected, hits, third time's the charm, can't get through. What does that mean? Price drops, and then you get the same thing, the bear flag to form right here. This is incredible stuff. I mean, this is literally a masterclass in technical analysis, folks, in understanding the basics of it. And the basics are all you need. Just understand trend lines, resistance and support, flag patterns, topping tails, like the basics of it. And all of a sudden you go from someone who's guessing, who's getting caught with the FOMO, the FUD, the fear, the greed, all of these things. And all of a sudden you say, wait a minute, no, the chart's telling me this, but all of social media is telling me this. And yes, it's a pivot low here, but really you're probably going in to test all of these levels. And there's something that I was looking at in terms of charting, right? When you zoom out and we go back to the 2017 high, bull market high of 2017, here's the bull market high of 2021, right? If we take a look at after this, look at this, guys. So here we had our high zone, right, of 2017. We had our bull market breakout, retrace up, and then look at where we came back to. We basically got here, and think about this, guys. So this high was about 20,000. We came back to about 16,000. So essentially we pierced the high by about 25%. And so what you're really looking at here is you're saying to yourself, okay, well, if that math works, then shouldn't this zone be good support, right? Because here's your high at 69,000. And I guess the question would be is what would be a 20% drawdown of that same or 25% drawdown from that high? And again, we could see here, let's see, we would go down. Actually, that could bring us to about 50,000 there. But ultimately, I am going to start buying here because what we can see is that essentially you pierced. So here, this high from 2017, as you came in, you pierced that high. And that's kind of where the bottom, like looking back, don't we all wish we loaded the boat right down here, right? And so essentially what we're looking at is we're looking at a cycle that is going to take us back into this zone here. And that's right in this range. So essentially sub 70,000. And listen, do I think this is going to be the ultimate low? No, but this could be a good for me. And I can only speak for myself, guys. I can only speak for myself. this would be an accumulation zone where I start buying Bitcoin. And then, of course, I'll leave room to dollar cost average because that's what I do. I've learned that I'm horrible at picking exact to the penny lows or highs, but I can get the general range down. And really, if you can get the general range down and you dollar cost average, the math works out, right? Because you bring your average down as it goes lower. And then when you get the bull move, you make a lot of money. Okay. So that's kind of the thought process here. Now, I do want to talk about a worst case scenario here, and there is a cause for concern. Now, the worst case scenario here. And again, I'm by no means saying I subscribe to this, but as a technician, I must look at the worst case scenario all the time, right? And I have to be aware of it, just like I have to be aware of the best case scenario, right? So in terms of worst case scenario, we have a pattern called a head and shoulders on Bitcoin. And if you can calculate out that target, and the only way this would occur or this would hit would be if the stock market has a major decline. And I'm talking about 20 to 30% minimum decline on the stock market. If that happens, then Bitcoin's probably going to achieve this target. Let's take a look here, and I'm going to show you what I mean. So the pattern formation, and I'm going to take away this line, and even right here, let's get rid of all of this, even this trend line up here. You guys, I already talked to you guys through it. The pattern is pretty simple. Shoulder, head, and shoulder. And the neckline is connecting the armpit right here. And now the trigger is when you break below the neckline, and that's been triggered. Now, how do we calculate the target? What we do is we take the highest point, which was the October high, and we drop a plumb line straight down to the neckline. What we do is wherever we break the neckline to the downside, you look for what's called a measured move, and that gives you a target. And if this did play out to target, you're looking at about a $35,000 to $36,000 price target on Bitcoin. Hey, what's kind of freaky about that is, look at this, guys. What's the average decline in past bear markets? What, 70 to 80%? And look at that. So if we look at this, look, last decline was 77%. This would be about 72%. Now, again, I want to strongly rebut that I am showing you the worst case scenario in my mind, like the worst of all worst case scenarios for Bitcoin. All right. At least that I see. I don't think if I thought it was going there, I wouldn't buy until it got there. Right. But it's my job to look at all angles.
Specifically, I'll start with what's happening in the metals market. The fact that gold has been absolutely on fire. I mean, this thing hits 5,500. We see immediate retracement, as you can see right here, another trillion off its market cap. The big issue is all of this being centered around crypto? I'm curious because it's very possible we could see a lot of liquid going into gold, and maybe the volatility is being traded now, much like the crypto market. Maybe that is where the investments are coming in from gold. All right, so let's jump over to this X post. This is by Bull Theory. This is a new account I like. So you guys give him a follow over there. Let's just do it right now. One thing that's cool about this is he wrapped up a little bit of what was happening throughout the Fed meeting yesterday. Much of it kind of mirrored the scenarios that we saw, but the lineup, I think, is pretty straightforward for most people. The Fed's done hiking. Inflation pressure is fading. We know that. Tariffs are still the main risk. I don't necessarily believe that's the case. I think these taco scenarios are more market driving than they are Fed dictating. The next expected move right now is eventually a cut, not a hike. Question is when? Does he do it before he steps out of office, or is it going to come back when we get a new chair coming in? Financial conditions no longer being tightened. We inspected that. I think this is where easing is going to start moving its way in, whether it's stealth QE or full QE is the question. And the system is shifting from restriction to stabilization, which I agree with that. Of course, the tightening cycle is over. I think the market is definitely waiting for an easing cycle in general. Powell was very specific around his statements yesterday in the meeting, and they weren't giving any forward look. They were still slightly concerned about inflation. Jobs was the big one. That was pretty much off the table because we've seen a little bit of an easing in the job market, which has been good, I think, in general. But really, when it comes down to it, when you look at where the market is right now, it is responding to yesterday's pause. But more importantly, it's responding to what's happening in the Clarity Act. And of course, that is a big deal. All right, so I want to get into a quick clip here by Tom Lee that is breaking down the expectation of the crypto market and what he thinks. Take a look.
Crypto's been a huge disappointment because, whether it's debasement or geopolitical uncertainty or central banks easing, those are tailwinds for precious metals. It really should be a tailwind for crypto. But I think crypto had suffered and still hasn't recovered from that October 10th deleveraging. So you've seen the crypto market trying to recover. And in fact, early this year, there was probably some momentum until the whole Greenland surprise, and that caused another round of deleveraging. So I think crypto, if in my opinion, is really watching this huge move in precious metals. There's a lot of FOMO for crypto traders, and I think they're actually buying metals. But in the past, these large moves in gold have actually been a precursor to a subsequent move in crypto. So I think part of this is we're seeing a big move in sort of non-US dollar assets, and that follows with.
All right, so I want to go to a quick tweet here by Sans. This was a good wrap up. Obviously, we know what was happening. We talked a little bit about this yesterday, and that is that the banks are in full combat mode. They went to the White House. They, of course, are raiding the SEC, trying to get the SEC's position recalculated. And then, of course, the problem that they're claiming is with Coinbase. So Ripple and others are fine, but Coinbase is the problem. And the other issue is that this now, because of these conversations, has now left a bad taste in their mouth from these talks. So things are not looking good between the banks, Coinbase, and I think the broader industry. The question will be, does Coinbase get ostracized out of the negotiations? I don't see how that's possible with everything else that's going on. I want to go to a clip here by Cory Booker that talks about this ag bill and how this translates into clarity. Take a look.
We also said, very importantly, we want protections for self-custody and innovative technology. We do not want to be criminalizing people who are writing code. And so I was excited. I went into the holidays, I got married, and I came back to this committee and start the year with the news that my Republican colleagues were walking away from the bipartisan process that produced the draft. To be clear, the product put before us today is not the bipartisan draft that we're working on. We've come so long, and I sat with stakeholders literally last night. We were clearing up some of the DeFi differences that are not reflected in this bill. The White House has made this infinitely harder. And I've had private conversations with Republican colleagues, staffers that agree with me. So I'm just going to say right now, I've had one of the best experiences I've had in my 12 years in Washington working with Senator Boozman. Let's get back to work. We can finish this in the next week or two in a bipartisan way, have a celebration. I may drink some milk, and we can dance in the end zone when we get this across the line. That's what I'm asking. But until then, we can't support this partisan draft. Thank you, Mr. Chairman.
It looks like the White House are taking the bank's side. All right, so here was a statement from the SEC quickly responding to what was basically the banks raiding the SEC yesterday. One day after that, they came in with a statement on tokenized securities. And the point that we get into is this right here. First model custodial tokenized securities, regular ones you KYC in, you own them just like any other, you vote, all those regular things you get with owning a stock. Then the second model is synthetic tokenized securities. So this isn't an obligation of the issuer to reference security. Basically what they're saying is this is now going to require KYC. So they're locking down tokenized security. I want to say the banks are locking down tokenized securities. And this is going to put a lot of pressure on the rest of the market as we go into this. Now, remember, Robinhood is in the midst of launching this as well. And I would put that Robinhood is also on the bank side of this. We kind of mentioned this yesterday. Let me kind of show you this right here. This was interesting because where Robinhood right now, if you look at just the value of tokenized shares on Robinhood continuing to explode, this is just going to be the beginning. Again, this is a KYC platform. Robinhood is going to launch these. It's going to go live on KYC. And of course, the thing that it's going to go live on is Arbitrum. I want to go to a clip real quick that announces a little bit more what this is going to look like. Take a look.
So today they have over 1,000 equities that they've launched on Arbitrum 1. and they've announced that they'll be launching their own chain, which is the Robinhood chain. I don't think that they've fully publicized the details of the customizations of their chain yet, so I don't want to steal their thunder. But the idea is that you can really customize anything about the chain, from the permissions, to the privacy, to the gas tokens, to the governance. But what Arbitrum Orbit gives you is the ability to have highly customized, highly opinionated block space that's tailored to your business and your product. And that's what I expect Robinhood and other institutions to do with the chain stack, not to launch vanilla Arbitrum One that just looks like every other chain, but something that's really, really uniquely tailored to their business. And, I look forward in their case to them announcing some of those customizations.